Okay, so like trying to make sense of the economy right now,
Mm.
it feels like, uh, well, it feels like you're stuck in one of those escape rooms where the clues are all misleading.
Yeah,
You know what I mean? And the rules keep changing, and half the people in the room with you are actively working against you.
absolutely. It
Yeah.
can be incredibly disorienting, to say the least.
Yeah. It's tempting to just like want to throw your hands up and say, forget it.
Right.
But you guys are here. So that means you are, well, smarter than average, and you're looking for like a shortcut through the maze.
We aim to be that shortcut.
Right. Yeah. And today we're diving deep
Yes.
into the latest dispatch from the Macro Butler.
Ah, yeah.
And their new report is, well, has a title that's basically begging for a deep dive. Lost in the Transitory Tariff Stoked Stagflation.
Quite a mouthful.
I know, right? So our mission today
Yes.
is to like help you guys extract the core insights from this report.
Right.
The stuff about like where the economy is actually headed,
Yeah.
and especially this whole inflation versus growth tug of war.
Absolutely. And the focal point for this whole analysis is the Federal Reserve's recent meeting and their latest set of economic projections.
Right.
So it's essentially the Fed attempting to give us their updated roadmap, even if the terrain ahead looks a little treacherous.
Okay, so the big news from the Fed meeting
Yeah.
was that they're keeping interest rates right where they are for now,
Uh-huh.
that 4.25% to 4.5% range.
Right.
Not exactly a shocker there, I guess,
Yeah.
but the statement that they released afterwards, it had a pretty noticeable shift in tone.
Oh, yes.
You know, they used to say that the risks to inflation and employment were like roughly in balance.
I remember that, yeah.
But they quietly dropped that phrase this time.
Interesting.
And now they're saying that uncertainty around the economic outlook has increased, which like in Fed speak is kind of like a flashing yellow light on the dashboard.
It's a subtle but meaningful change in language.
Totally. Yeah.
It suggests a recognition that the odds of some negative economic surprises,
Right.
well, those odds have gone up.
Okay, so, and it seems like those potential surprises are starting to show up in their revised economic projections too. They've like taken a knife to their GDP growth forecast for 2025.
Really?
Yeah, slashing it from 2.1% down to 1.7%.
Oh.
Outright. And at the same time, they're cranking up their inflation forecast.
Okay.
They now see year-end core PCE hitting 2.8%, up from their previous 2.5% estimate. And just to add a little extra spice to the mix,
Yeah.
they've slightly raised their projection for the unemployment rate in 2025 from 4.3% to 4.4%.
So slower growth, stickier inflation, and potentially more people out of work.
Yeah, it's not exactly painting a picture of like economic bliss.
It's certainly not a rosy picture.
Right.
It seems we're seeing the classic ingredients for stagflation beginning to blend together.
Ugh, stagflation. I was hoping we'd left that term back in the 70s.
Right, but unfortunately it seems to be making a comeback.
Okay, so for all you econ nerds out there,
Yeah.
the Macro Butler also digs into the infamous dot plot.
Ah, yes, the dot plot.
You know, where each Fed official like secretly writes down where they think interest rates are going to go.
It's always an interesting exercise in Kremlinology trying to decipher the collective thinking of the Fed.
I know, right? So the median projection right now for the Fed funds rate at the end of 2025 is sitting at 3.88%,
Okay.
which means they're still anticipating a couple of rate cuts down the line.
Interesting.
So even with all the uncertainty,
Yeah.
they're not completely ruling out some relief on borrowing costs.
But of course, it's just a snapshot of their current thinking.
Right.
The actual path of interest rates will be highly dependent on how the economic data unfolds.
And speaking of things unfolding, the Fed also announced that they're hitting the brakes on shrinking their balance sheet.
Oh, really?
Yeah, they're reducing the amount of assets they'll let mature each month without replacing them from $25 billion down to just $5 billion.
That's quite a slowdown.
It is, right? So why the sudden change of pace?
Yeah, I'm curious too.
Well, the Macro Butler suggests it's because the Treasury isn't pulling as much cash out of the system as they planned.
Okay.
Apparently, all the drama with the debt ceiling
Right.
has led to like a slowdown in the issuance of Treasury bills.
Interesting.
Yeah, so it's all connected, you know?
It's like a giant financial ecosystem
Yeah,
where even a small disruption in one area can have ripple effects throughout the whole system.
totally. And then there's the whole tariff situation.
Ah, yes, the tariffs.
So Powell got asked directly about how tariffs are playing into their revised inflation outlook.
Of course.
And he admitted, clearly some of it is due to tariff.
He did acknowledge that, yeah.
But then he quickly added that they're still like crunching the numbers to get the full picture.
Right.
And he even brought back that infamous T word,
Transitory.
Transitory, yeah. Like maybe the inflationary effects of tariffs will be temporary.
Yeah, we've heard that before.
Right, or maybe not.
And the last time, transitory was all the rage.
Exactly.
Well, inflation didn't exactly agree.
Okay, so let's see how the markets reacted to all this Fed speak and data.
All right.
So the stock market, in its infinite wisdom, seemed to focus on the lower growth forecast. Maybe hoping for more rate cuts down the line.
Possibly.
And the fact that rate cuts are still on the table, and the slower pace of balance sheet reduction.
Okay.
So this combination fueled the S&P 500's best Fed day since July 2022.
Wow.
And the NASDAQ did even better.
That's quite a rally.
Yeah, it seems like investors are feeling optimistic about consumer discretionary energy and IT.
Interesting.
While real estate and healthcare took a little bit of it.
Okay.
It's like everyone's got their own economic narrative going on.
It seems so.
Meanwhile, the money markets the optimists are still betting on around 3 rate cuts this year.
Even after Powell's more cautious tone.
Yep. The dollar didn't really do anything dramatic.
No.
But gold, on the other hand? Well, gold just keeps shining, hitting a new all-time high.
Gold seems to be the asset of choice these days.
It does, right?
It seems like more and more investors are waking up to the reality of stagflation
Yeah.
and a general lack of trust in institutions, so they're flocking to assets that don't rely on promises.
Like gold.
Like good old physical gold, exactly.
The Macro Butler calls it an anti-fragile asset.
An appropriate term, I think.
Yeah. It sounds like something out of like a fantasy novel.
Right.
Okay, and speaking of things that aren't moving much when maybe they should be,
Oh, yeah.
the U.S. 10-year Treasury yield is basically stuck in a rut.
Huh.
Yeah, it's hovering around its 200-day moving average,
I see.
which the Macro Butler finds a bit odd considering they think the Fed and government actions are going to push long-term yields way higher in the future.
That's an interesting divergence.
They even said that the once-upon-a-time risk-free rate is no longer free of risks.
Haha. I like that.
Right?
It's a good point, though.
Yeah, so now we get to the thought section of the Macro Butler's report.
All right.
And this is where they really start to deviate from the Wall Street script.
Oh.
So they've been looking at the historical relationship between the Fed funds rate and the business cycle, using the S&P 500 to oil ratio as their benchmark.
I see.
And what they found is that decreases in the Fed funds rate have historically coincided with the peak of that S&P 500 to oil ratio.
Okay.
And even more interesting, they say that no matter what the Fed does with rates, that ratio has always eventually fallen below its 7-month moving average, which they see as a sign of the shift from an economic boom to a bust.
So they're suggesting that the Fed is more of a follower than a leader.
Exactly. They're saying the Fed's been more like a passenger than the driver.
It's a provocative argument, for sure.
Yeah, and here's another head-scratcher.
Okay.
You know how Wall Street usually freaks out about rising inflation?
Oh, yeah. Inflation is the boogeyman.
Right. Well,
Oh.
the Macro Butler points out that historically the S&P 500 has actually had its best 12-month returns.
Really?
When the gold-to-bond ratio, which they see as a key indicator of the inflationary environment, has been above its 7-year moving average and rising. They're saying that when inflation is being driven by stuff outside the Fed's control, like shortages,
Right.
trade wars, geopolitical turmoil,
Okay.
that the usual economic playbook goes out the window.
So they're making a distinction between different types of inflation
Exactly.
and how they can have different impacts on the markets.
Yeah, they even use the example of skyrocketing egg prices
Ah, yes, the eggflation.
because of shortages and tariffs.
Makes sense.
Like the Fed messing with interest rates isn't going to magically make more eggs appear.
No, it won't affect the supply of eggs directly.
And they go even further, suggesting that, fundamentally, inflation is economic growth, while deflation is economic contraction.
Okay.
Which leads them to ask a pretty radical question.
What's that?
Should we really be so scared of inflation?
Interesting.
And so happy when our assets are losing value in real terms?
It's a thought-provoking perspective.
Right, it makes you think.
It does.
Okay, and they also highlight this kind of obvious correlation.
Yeah.
That interest rates tend to go down during recessions.
Yeah.
And go up during booms.
Right.
Which, duh, right?
Seems logical.
But they use this to emphasize the strong link between the Fed funds rate and the S&P 500's 12-month performance.
Okay.
And they're pretty critical of what they see as myths being spread by analysts in the mainstream media,
Oh, yeah.
who they accuse of not actually analyzing the data and instead creating confusion that benefits the financial elite.
Strong words.
Right.
But I can understand their frustration.
Yeah.
There's often a disconnect between the theoretical world of finance and the real world.
Totally.
Yeah.
So The Macro Butler's main argument
Yeah.
is that the stock market's performance ultimately comes down to the business cycle
Okay.
and how it affects corporate earnings.
Right.
So when that S&P 500 to oil ratio starts going down and dips below that 7-year moving average, it's usually a sign that corporate earnings are about to decline.
Which is typically when the Fed starts cutting rates. It's a logical chain of events.
Right.
A declining S&P 500 to oil ratio suggests energy costs are becoming a bigger drag on corporate profits,
Yeah.
which can lead to an economic slowdown, and then the Fed steps in to try to ease things up.
Okay, so now for the not-so-fun part.
Right?
They're saying that stagflation is bad news for basically everybody.
Yeah.
Stocks, bonds, the whole shebang.
Because the real problems,
Right.
the tariffs, the wars, the taxes, the government spending,
Yep, all that stuff.
those are things the Fed can't really fix with interest rates.
Yep. And they're warning about the possibility of negative inflation-adjusted returns
Ouch.
in an inflationary bust.
That's a scary thought.
Yeah.
Losing money even when your investments are going up in nominal terms.
Right.
Because inflation is eating away at your purchasing power.
Exactly.
It's a recipe for financial pain.
Okay, and they also say that the S&P gold ratio can act as an early warning signal.
Oh, really?
Yeah, they say it tends to lead the S&P WTI ratio by like 3 to 6 months.
Interesting.
No, WTI, that's oil. Basically signaling that shift from boom to bust.
I see.
And looking back historically, they point out that whenever the S&P 500 to gold ratio has dropped below its 7-year moving average,
Yeah.
the Fed has often felt like they had to hike rates.
To try to support the dollar and fight inflation,
Exactly.
which often ends up triggering a recession.
Right. So they're wondering if the Fed might actually have to reverse course and raise rates again in 2025
Wow, that would be a surprise.
to protect the dollar and try to tame inflation.
That would be a major policy shift.
Yeah.
It highlights the difficult situation the Fed is in.
Totally. Okay, so let's get to the Macro Butler's key takeaways
All right, lay it on me.
because they're not holding back.
All right.
First, they say flat out that the Fed is politically data dependent, but economically and financially irrelevant.
Wow.
Yeah, they're convinced that stagflation is coming back thanks to all the wars and new government spending programs.
It's a grim outlook.
It is, right.
So what are their recommendations?
They're urging Wall Street to wake up and realize that the Fed isn't some magical fix-it tool,
Okay.
and that corporate profits are heavily tied to energy costs.
Right.
They also don't think rate cuts are going to solve the underlying economic issues. They're predicting more economic and political instability,
Oh, boy.
leading to a stronger dollar, higher treasury yields, and even more expensive oil and gold.
So a flight to safety.
Yeah, and a decline in trust in public institutions.
Which pushes investors towards things like gold, silver, platinum.
Right, tangible assets that can't be easily confiscated.
Okay.
They're also warning long-term bondholders to get ready for more pain
Ouch.
and suggesting that a big chunk of your portfolio, like 25–40%, should be in physical gold
Will.
as the best way to protect your wealth during an inflationary bust,
While avoiding long-dated bonds.
like the plague.
Got it.
They're saying to buckle up for way more volatility and to expect pretty lousy inflation-adjusted returns for a while.
Not exactly an optimistic scenario.
Yep.
But it's important to consider all perspectives.
Totally.
Even the more pessimistic ones.
And their bottom line is even more blunt.
Okay, let's hear it.
They're arguing that current economic theories are ignoring some basic realities,
Interesting.
and that policies based on these flawed academic ideas are going to fail. They're calling for a whole new economic framework.
Really?
Yeah, one that's actually grounded in the practical realities of the business cycle and real-world experience.
So they're advocating for a more pragmatic approach.
Exactly.
One that's less theoretical and more connected to what's happening on the ground.
Yeah, they're even taking a swipe at academics who've never actually traded anything,
Uh-huh.
but are making pronouncements about the economy.
I think I know a few people like that.
Right. It's like getting driving lessons from someone who's only played racing video games.
Yeah, that's a good analogy.
Okay, so finally, they lay out their investment advice.
Oh, yeah, hit me with it.
They're recommending a substantial allocation to physical gold, 30–40%.
Wow, a big bet on gold.
Yep. For stocks, they like companies with low debt and consistent growth,
Okay.
and suggest buying dips in energy and aerospace defense,
Interesting.
but being cautious on energy consumers.
Makes sense.
They say to stay away from long-term bonds
Mm-hmm.
and instead go for short-term investment-grade corporate bonds.
Okay.
And as the inflationary bust gets worse,
Yeah.
they say to shift out of longer-term fixed income and into more physical precious metals.
A move toward tangible assets.
Exactly, prioritizing preserving your capital over chasing returns.
A defensive posture.
Yeah, and then they leave us with this real thought-provoking idea.
Okay.
They suggest that all these policy blunders and manipulated information
Right.
might actually be part of a deliberate Marxist agenda.
Whoa, that's a bold statement.
I know, right?
It certainly adds a whole new layer of interpretation to the economic analysis.
Yeah, so to sum it all up, the key takeaway from the Macro Butler is that the economic landscape is super complicated right now,
Absolutely.
with all these factors like tariffs creating a situation where the Fed might lose control and we could end up in stagflation.
It's a real possibility.
And that brings us to you guys.
Yeah.
What are your thoughts on all this?
How does this analysis change your view of the economy?
Yeah, and maybe even your own investment strategies.
Given everything we've discussed, what factors do you think are being overlooked
Right.
that could have a big impact on the economy in the coming year?
It's a complex situation, and it's important to keep exploring these ideas as we move forward.
Absolutely.
Thanks for joining us,
It's been a pleasure.
and we'll see you next time on The Deep Dive.
Until then.